Yeah, you're absolutely correct. It started with Goldman Sachs, but investment banks have all been raising their predictions for gold. Goldman Sachs raised it to 3,300 by the year's end, up from 3,100. And this is on the back of gold growing 36% over the last 12 months. Two big factors driving this increase in gold prices and gold predictions. One you've mentioned already in a roundabout way, and that is uncertainty. Nobody knows exactly what's going to happen on April 2nd, and investors know that during unsettled time, gold offers unparalleled security. So there's a move in that direction. The second driver, and I think the bigger of the two, central bank gold buying. Right? 3 consecutive years of over 1,000 tons added to central bank gold reserves. And then we've seen a pickup in that since the election, I think amid heightened uncertainty now on US trade policies. China, along with other central banks, are rapidly accumulating gold. They're saying for another 3 to 6 years to hit their desired gold reserve allocation targets. Most central banks around the world, on average, keep about 15% of reserves in gold. China, at least publicly, only have 4%. So they've got a lot of catching up to do there. But as I mentioned at the beginning, Goldman are not alone. Double Line Capital, Societe Generale, UBS all predict gold over 4,000 over the next 2 years. And on Tuesday, Bank of America raised their year-end prediction to 3,300. Their analysts cited investor demand, central bank demand, but also the fact that China's insurance industry is now getting pressured by regulators to buy more gold. Obviously, there's a squeeze on them, and gold is the safest of safe haven assets. Something mentioned in Goldman's report that could put a short-term squeeze on gold prices is a potential Russia-Ukraine peace agreement, but they didn't expect it to have long-lasting impacts. There were some interesting things that they mentioned on supply and demand, though. On the supply side, they said sort of lifting the sanctions on Russian-produced gold probably will not materially increase supply because that gold's already hitting the markets through rerouting. The interesting part that they said was on the demand side. They said the precedent set by the 2022 freezing of Russia's central bank assets has structurally shifted how reserve managers think about asset safety. That, for me, was the big concept here. This is what we've been talking about for the last 3 years, and investment banks, now appear to be catching on. Look, in 2022, when Biden weaponized the dollar and froze Russia's reserves, he essentially created another dimension of risk that really hadn't existed before in a meaningful way. And it immediately led to an astonishing increase in central bank gold buying that, quite frankly, hasn't let up since. But I think what ultimately has happened is this historic correlation between real and after inflation yields on cash and gold price has just broken down, right? Before this shift, investors only really owned gold when they were really worried about inflation, right? But when holding dollars was still profitable after that bout of inflation, they switched back from gold to dollars. And this dynamic held for about 50 years. What we're seeing now is a global shift in what really qualifies as a safe haven asset, a shift away from dollars towards gold. Look, trust and faith in the US dollar, like anything broken, is much easier to shatter than to repair. It took 200 years for us to secure global reserve currency status, and Biden squandered that in a day. And what we're seeing now is the fallout from those decisions. And it's things like this that are making President Trump's job, particularly when it comes to the economy, very, very difficult.